Okay, guys, so welcome, ladies and gentlemen, to another episode of Passive Investing in US Multifamily Show. I'm Jefferson Ortiz, and I'm here with my co-host, Jonathan Ortiz. In this podcast, we dive into multifamily real estate in the Sunbelt region and the Midwest and other parts. Now, what we do is we partner with passive investors to explore this lucrative sector in multifamily. Okay, ladies and gentlemen, prepare to be inspired by a real estate giant. Joining us today on Passive Investing in US Multifamily Show is Jorge Abreu. I don't know if I'm saying that correct. You can correct me after George. He is a titan in the industry. George's journey is truly inspiring. He's wholesaled over 250 single-family properties. He's renovated and flipped over 200 homes and taken on some massive groundbreaking development projects, totaling over $40 billion in ground-up construction, which we're definitely can't wait to hear more about. And then beyond these milestones, George established a construction company that has generated over $30 million in yearly revenue. Yet that's just the start. He's a full-time multifamily real estate investor, leading Elevate to acquire an outstanding 7,737 multifamily units, successfully exiting over 1,600 units. Elevate now oversees an impressive $550 million in assets under management. So not only this, but George is happily married. He has three beautiful girls. So let's discover the incredible story and wisdom from George, CEO of Elevate Commercial Investment Group and GMT Construction. So George, welcome to the show.
Thank you, man. Thank you for that introduction.
George, your journey's been nothing but remarkable. Could you walk us through your early days in real estate, particularly how you ventured from wholesaling single-family properties to scaling in large multifamily projects?
Absolutely, man. So, when I went down this path of becoming a full-time real estate investor and decided to leave my W-2 at that time, the goal was always to scale and to build something larger than myself, right? When it came to the real estate firm. And when I originally started off, first thing I learned was single family homes and wholesaling, right? That was the quickest and easiest way to get in. So started doing a good amount of those and enough to quit my W-2, and then really started liking the fix and flips and taking these ugly homes and then transitioning them and selling them to a retail buyer, and really focused on that for while wholesaling, right? We would wholesale the deals we didn't really want or didn't fit our criteria. And then we would keep the ones that we liked. And, in doing that, that's when I decided to start a construction company as well, because I was having trouble, once again, going back to scaling. I was having trouble finding enough good contractors. So that's when we decided to add the construction arm and doing quite a bit of volume on a yearly basis as far as the fix and flips and wholesales. But I was still I was hitting a brick wall at a certain point where I just couldn't figure out how to scale any larger than what I had gotten to. And around that same time is when I got introduced to multifamily syndications. And, before I even knew that you can do a syndication to acquire a multifamily property, I thought you had to come in with millions and millions of your own money to buy these large apartments. So that kind of blew my mind, and I started focusing and really taking in the knowledge of, okay, how do I acquire these 100+ unit apartments? And it took me about a year or so to get comfortable with the underwriting and just, completely different from when it comes to investing in single family, the way you value multifamily properties and even just the jargon and everything that goes around multifamily. Not that I didn't learn from the single family, but it's still very different, right? And then I started doing some deals. I started investing passively as well, which I had never done, right? Around the same time that I was looking for my first syndication. And I think that helped in the aspect that I started seeing the benefits right away as far as depreciation and just getting distributions, right, and passively. So that helped me when it came time to start raising equity myself for our deals. And eventually so at first I was trying to do both, right? The single family, I kept the single family going, and I was starting up the multifamily. But, at one point I decided to just stop doing single family altogether, sold off whatever we had. And when I really started focusing all my time towards building that portfolio, that's when things, started taking off.
Wow.
Wow. No, that's phenomenal. And something I wanted to touch on, and I think is really important, you pointed it out, is you invested passively. And that's actually how we got into our first deal as well. Invested passively. Now you can talk the talk, you can show investors, you can walk them through the process because you've gone through the process. And again, you see the benefits of it. You see those mailbox checks coming in and whatnot. But as well, obviously, I know you're on the active side, but just wanted to point that out. And then in regards to, you went from wholesaling, you flip properties. How much do you think those aspects have shaped you when it came to the multifamily? Because obviously with the wholesaling, you're finding the deals, with the flipping, you're renovating the property. So I feel like, would you say that some of those skills transition really well when you came into multifamily?
Absolutely. I mean, we found our first two deals by pretty much hunting for them, similar to the things we were doing with single family, direct to seller, and that was very helpful. Nowadays we do a lot through brokers, and we don't do so much direct to seller, but it definitely helped us get our foot in the door. And then just having that construction background, and that was a huge piece to it as well, right? We were able to feel confident going into these deals that we knew how much it was going to cost to do the renovations. We even had some groups take us into their GP because of that experience, right? So, yeah, I mean, I think both of those played a crucial role in probably the speed that we were able to move and build the portfolio.
That's great, George. Obviously, beyond your success in real estate investment, you've also established a thriving construction company that's generated over $30 million in revenue. How did this construction enterprise intertwine with your multifamily investment strategies, and what pivotal role has it played in elevates growth over time?
Yeah, I mean, look, a lot of the times that becomes a bottleneck, or even it gets other investors into issues because they hire a contractor that eventually ends up screwing them over, or they're not detailed enough with their scope of work, or they miss things during their due diligence, and it ends up costing them and really having the deal go south, or not be as profitable as it could have been, right? So I think having that knowledge and having that construction arm in-house has really helped us be able to focus on the other things, and know that, hey, we've built out this team, we've built out this system, and the construction part is going to perform. We're going to be able to execute this business plan. We're going to do it quickly. So yeah, I mean, I think it's been pretty essential. I'm not saying that everybody needs to go out there and have a construction arm, but they do need to find a partner or a GC that really has that multifamily experience and is reputable.
Yeah, no, absolutely. And I think something you touch on, and I think it goes to show, what kind of separates you. And that's kind of where I was going with my next question. But a lot of people talk about, hey, I just closed on this property. Hey, we got this property in the contract. But you don't hear as often about people when it comes to the reposition, hey, we're stabilizing this asset. We've done these construction, we've done these renovations. And I see that's something very different with you guys. You guys are very active, showing people what it's like once you close, right? Like getting to the finish line is just one, but then now the fun really begins. So George, I wanted to ask you, when it comes to the success that you guys have had, you guys have made tremendous growth, 7,737 units and counting. You've gone full cycle on 1,608 units, and obviously your portfolio currently over 450 million. I mean, it's very, very impressive. In your words, what has separated you from the pack, per se, or other operators? I know we talked about the construction company and stuff, but what else do you think has really separated you from everybody else?
I think we've been very focused on the team, and that's something that I've learned throughout the years. I've been a business owner, I guess, going on 17 years now, and I've learned a lot of things throughout those years. And one of them was that if you want to truly build a business and scale, that you've got to create that team, right? And really care about the team, and also have the systems in place, right, to do that. Being a one-man show or just not having the right team around you, it makes it very, very difficult to be able to scale your business. So I think that's something that we put a lot of focus on. since day one, and it's paid off.
That's amazing.
Yeah, well, I know Brian also mentioned you guys are on the process of hiring more people, so you guys are building that foundation even further and expanding on that. So I feel like that's really important, right? So wow, incredible.
George, your goal is to reach, over 10,000 doors. That's ambitious and amazingly here. How are you strategically positioning Elevate for this growth? Are there specific partnerships or systems you're implementing to facilitate such stability? Can you tell us a little bit as to why that goal is important to you?
Yeah, I mean, look, I think it's just a number at this point, but it's one to me that shows the stability and the fact that, hey, we've gotten up to a certain scale, and some of the things we're doing to get there. One of the important things we had was bringing management in-house. So we did that about a year ago now, and it's been pretty crucial component to that. It goes back to one of the reasons I brought the construction in-house. It's just more control, and once again, when you're trying to scale, you've got to be able to have these systems. And with third-party contractors or third-party management, we've just found it very difficult to be able to control some of those things. And so yeah, I think that's how we plan on getting there. Obviously, I mentioned the team as well, building a really good team around us. And yeah, and I think we'll get there soon enough. We're still also being very picky with the deals that we move forward with. This year we had much larger goals going into this year, but the market is what it is, and we kind of scaled down on that. I think we're going to end up with 4 deals that we closed when our original goal was to close 12.
I mean, which is incredible, because I mean, most people right now are on the sidelines. Some people are not even acquiring anything this year. So the fact that you guys can still acquire those assets and still, pick up specific assets based on the underwriting is really crucial. So that's actually something that I wanted to ask about. With your vertical integration with property management, with the construction team, would you say that this allows you to take on unique projects, such as, like, I know we talked about it with Brian, maybe you can touch on a little bit, some of the newer projects, some of the A-class that you guys are buying. And can you talk a little bit about that and how that infrastructure has helped? And you guys can get deals done where somebody who maybe doesn't have that in-house property management, in-house construction company may not be able to take that project on?
Yeah, no, absolutely. I mean, I think a lot of people look at an A-class deal and they think, how can you add value to it? Well, a lot of it is going to be in the efficiencies, right? And in the management, and being able to manage that property better, be able to push the rents. These A-class deals that we're acquiring, there is a value add, right? We're not acquiring an A-class deal that's getting top of the rent, in that market. There's a 150, 200, whatever it is, rent bump that's clearly there, and they just haven't pushed for it. So we're coming in, we're getting those higher rents, we're managing it with the expenses, we're lowering expenses. And I think without the management in-house, that becomes a lot more difficult to do. So yeah, I think it definitely helps there. And then we're also able to be very efficient with our CapEx and the dollars we're putting into the property, and still keep it at a low basis.
Interesting. Amazing to hear. Thanks for sharing that, George. We've received a couple of inquiries from our audience regarding multifamily investment, especially the newer investors, in regards to fluctuating interest rates. How do you foresee the trends evolving and impacting the market in the incoming years?
Yeah, look, I mean, I don't think anybody was expecting the interest rates to rise as quickly as they did, right? I think everybody got a little caught off guard there. There was a big push for adjustable rates for a bit, right? Because the spread was so low and whatnot. But what we've done is we've positioned our deals to be in a fixed rate. I know it sounds simple, and a lot of the deals we're closing on right now are loan assumptions at lower rates, or we have, if we've got one that we're going in with a new debt, which we closed one, I believe it was September, we're getting it where the price makes sense, right? And it works with today's rate, and we're getting a fixed rate. Bridge loans have a place in acquisitions, but they weren't being used for that, right? A bridge loan should only be when you're buying a heavier value add deal and it can't essentially get approved for agency type loans, and you really need to just bridge that gap till you get it stabilized. I do think we haven't closed on one recently, but you know, if I came across a deal that was the basis was low enough and it made sense, we would go in with that bridge loan. We would, you know, get a rate cap for the maturity of the loan and quickly execute that business plan and get out of it into a fixed rate loan. So I think, you know, back to kind of your question there is, interest rates drive a lot in the market and in the economy. So I think everybody's, that's been magnified, right? With what the Fed has done, everybody can kind of see that. We're still getting some of that's still coming to surface, right? With how fast they raised them. So you're starting to see the reports that are coming out now. It's showing what it's done to the economy, and that's why the Fed's kind of backing off. There's reports saying now that they're going to cut rates 4 times next year. I don't know if that's true, but we're not counting on that stuff. Is what we're trying to do, right? We know when we do our assumptions, we're being very conservative, and you know, I do think that rates are going to get.
Wow, which is really interesting, because essentially, and I've heard this from other operators as well, is that if you can make the deals make sense in today's high interest environment, when the interest rates go down, I mean, these deals are going to be potentially home runs, right? Because if you can run them in today's rates and they work. And no, I can agree with you. One of the deals that we mentioned earlier before we recorded was a deal in Savannah, Georgia, and we assumed the loan at 4.5 fixed for the next 10 years. And it was a brand new loan from last year. So it was a brand new, you know, essentially, you know, a new loan, still had a whole lot of life, and it worked up really well. So I think that there's going to be a lot more of that, and also some seller financing. I think seller financing is going to come back to the table now. You know, people are, you can already see it, I'm sure, with deals.
Yeah, we've used it on some of our deals already, and it's one of the first questions we usually ask is seller financing, and you can usually get some pretty attractive terms, you know, depending on the seller situation. But yeah, I think, look, this isn't the first cycle I've been through, right? I was a full-time real estate investor starting 2005. So, I mean, I went through 2008 and I didn't stop buying deals back then either, right? It was a lot harder, but every deal I bought after that on the down cycle, right, we ended up making a lot of money off those deals. And I think those that are sitting on the sideline haven't been through a real estate cycle and they don't know what to do. And I'm not saying it's hard to go out there and buy a lot of things right now, but the pricing is definitely starting to make sense. And if you're going to have to raise more equity because now your leverage is lower, if you can do it, I think it's a smart move. Yeah,
no, absolutely. No, that's awesome. And then, so another question that we had here, George, from our audience is, reflecting on your journey today, is there any advice you would offer to a younger self when starting in real estate, knowing what you know today? I know it's kind of, you know, one of those questions, right, where you're like, everything I went through, you put me in this position, but just anything that you can think of?
Yeah, I mean, look, I learned a lot when I was doing single family and building out the companies. But looking back, you know, I would tell myself, one, to go straight into multifamily for, you know, cash flowing properties and not to focus so much time on single family. And then 2, to really focus out on building the systems and building out the team.
Absolutely. Building a system and a team is absolutely crucial. Lastly, George, any impactful books that significantly shaped your multifamily real estate journey that you'd recommend to our audience here?
Impactful quotes?
Books.
Books. Sorry. Yeah, specifically for business, multifamily, or just in general?
I'd say just in general. Multifamily. Let's start with multifamily, and then any sort of personal development books that are your favorite. Let's start with 2.
Yeah, multifamily, man. I think Joe Fairless does a great job in his book, kind of breaking it down and making it simple. You know, best ever something multifamily syndication
the
book.
best ever apartment book. I think it's called syndication book.
Yeah.
Is that what it is?
Yeah. I think that one's pretty good when it comes to multifamily. When it comes to business, actually got it right back there. Traction. That was a huge one. Really helped me build out my companies. And business. What was the other one? Personal development, I think you mentioned. I think Tony Robbins has some pretty good books, but then man, one that, but yeah, there's a bunch of them out there, man. I don't know.
Those are good books. Those are good selections.
Yeah, George, we wanted to maybe touch on some passions or activities that you enjoy outside of real estate. How do you unwind and find fulfillment outside of your professional life?
Yeah, man, if I love playing basketball, I like working out, and then if I'm not doing any of those two things, it's spending time with my family. You know, my kids are, I got 3 girls, 10, 8, and 7, and they grow up quick. So I mean, any free time I really have is spending it with them.
Wow, that's very meaningful. No, and I'm sure that that's part of your why and part of what you do every
Absolutely.
what you do every day. No, that's awesome. And then I guess kind of to add to that question, how do you balance, personal and family time? Is there anything that you do like time management or anything that works for you?
Oh man, yeah. I mean, I've I was really bad at this at one point, and it kind of hit me. Like I just said, the kids grow up quick, so when you say balance, I think it's very hard to balance. First of all, what I do is when I spend time with my family, I'm there like 100%. I'm not on my phone. I'm not, I'm engaged. Actually getting to know my children and spend good quality time with them. I make it a point to not miss anything that's that I know is going to be important to them, right? If they're having some type of competition or anything with their school, I'm there. That's like you said, that's my why. And for me to have this flexibility in my schedule and kind of ignore that is silly, man. And I think it happens to business owners, especially. It's very easy to get wrapped up with everything, and I don't want to close my eyes and wake up, man, and just be like, what happened, right?
Yeah. No, and it happens, like you said, it happens to a lot of, business owners, and I heard a quote from someone. So just to kind of give you some background, myself, I'm married, got 2 kids, right? So can relate a lot to what you're saying. But a lot of people say, you're doing it for them, but they never asked for it in the first place, which I thought it was, it's one of those things that
all they want is you to be there and your time.
Yeah.
So,
George, just to kind of, shift gears a little bit. Right now, obviously started with single family, you did some wholesaling, you did it to the multifamily. Where, any specific markets that you're really targeting, in 2024 and going forward? And then, talk a little bit about the class of assets that you go after. I know obviously you've been in some A class. Are you still open to like B class, kind of done with C class? Like, just tell us a little bit about kind of your investment criteria there.
Yeah. So, market wise, we're pretty open to certain markets. We like to stay with landlord friendly states that have significant population growth, job growth, good fundamentals. So, I mean, we love Texas. There's certain things within Texas that make it a little difficult. Mainly taxes and insurance have made it harder. Same about Florida. We like Florida. Insurance has become really difficult there, though. We've done our last 3 deals have been in different markets in those 2, which Northwest Arkansas, which we like a lot of growth there. Kansas City, we're getting ready to close a deal there as well. We like that market and what we're seeing there. And then we've done 3 deals now in South Dakota. Wow. Which not a lot of people expect when they or even know where South Dakota is when we mention it. But we've had a ton of success there, man. And yeah, any good deals that pop up there, we're all over it.
Yeah. And I'm sure that you have like a specific things that you look for in a market before going into it. Could you speak a little bit?
Yeah, we like to see pretty simple stuff. I mean, we like to see over 100,000 in population. If it's a smaller city right outside of an MSA, a large MSA, we'll kind of depends how far away it is. We like to see constant population growth, trending, and dig a little further into, okay, why is that population growth happening? Usually there's job growth, right? Job growth leads to population growth. What is driving that job growth? Want to make sure it's not all concentrated in one, if it's all hospitality or something like that, we want to be careful, or if it's military, whatever it is. So a diverse economy, essentially.
Yeah,
Those are the
absolutely.
basics.
Absolutely. George, can you speak a little bit about mentorship, if you had any mentors, and how that has affected you, or perhaps if you have done any coaching or mentoring yourself to other real estate investors?
I will, but let me finish answering the last question, and I just remembered the book too. So it's
there you go.
personal development book is Can't Hurt Me.
Oh yeah, David Goggins.
Yeah, David Goggins.
I'm a big David Goggins fan.
And I'm calling that personal development just because, man, it made me just think twice about ever complaining about anything, and kind of pushing past what
Absolutely.
the
I
mind
actually,
thinks you can.
it's funny enough. After I started listening to him, I started going on these random runs. I just go run around and just have David Goggins playing
Yep,
at the back. So really
same
funny.
here, man. Same here. And then I guess I stuck on just the market, but asset wise, usually we're looking at 100 plus units. Sweet spot seems to be like 200 to 3 something units. Makes the management part of it a lot easier. And then we have been leaning towards the nicer properties, just A class, built after 2000. I just feel like the pricing between a C class and an A class got so close that it didn't make sense to take on all that risk on a C class when I could just pay a little bit more and get this A class property. Whether that begins to change, I think it might. I can kind of see it in the cap rates changing a little bit. So we'll still take a look at a C class heavy value add deal, but man, the pricing is just it's gotta be at a really low basis for us to jump on it.
And I've heard from other operators as well, when it comes to the exit, right? If you do buy an A class, usually you're selling it to an institutional or some sort of more sophisticated buyer, whereas the C class, with the year built and everything, like typically is not one of these large organizations that are acquiring it. Would you agree with that when it comes to the A class, B class?
For the most part, and I think it depends on the market. I mean, there's certain markets that institutions won't even touch. So I mean, it still depends.
Okay.
Yeah, George. We'll jump back on that question before the book. That if you've done it, how important is mentoring? If you've had any mentors, how that has helped your career growth, or if you've ever considered coaching other real estate investors.
Yeah, no, for sure. Yeah, I think, look, hiring a coach or a mentor, or even just finding one, right? That you don't have to hire and just wants to mentor you, or you can bring some value to them somehow and they can mentor you. I think it's huge. I think it shaves a lot of possibly years off of you gaining the knowledge, being able to learn from this person and not make the mistakes that they've made, because they're teaching you the way and teaching you from their experiences. Going into the single family real estate, I hired a coach, joined the coaching program, and I feel like that really excelled my growth. And then going into multifamily, I did the same thing, right? If it worked the first time, why not do it now, right? And same there. It helped me move quick. I do think it depends on the person. So I've seen people hire coaches and join mentoring programs and do nothing with it. So I mean, it comes down to you. You got to take action, right? Hopefully you vet them and you hire the right coach, then you've got to do what they're telling you to do and put it into action. But I actually have a small coaching program. I haven't really marketed it too much, here and there, kept it kind of small, but it's very hands-on, and I enjoy it. I don't maybe want to build this massive education arm of what we're doing, because I'm very focused on building out the portfolio, but I figured, meanwhile, I could help others kind of learn and we could help each other where, they look for deals for us, or they can provide other things. And then we pretty much can handle anything that they don't have, fill the gaps anywhere.
I love it. No, that's how partnerships are, and that's how. Just kind of give you a little background. We have invested in coaches and mentors. That's actually how we stumble across you. Cash Flow Champs was hosting one of those webinars, I think, on the weekend, and there was 2 different rooms. My brother Jon is my brother, so he went into one of the rooms and I went into the other one, and that's where I met you. You had a whole presentation, and I was like really impressed with everything you were doing. You were talking about what the kind of renovations you should be doing on these multifamily. You went into depth about a lot of details. That's how I followed you, and here we are, talking talking and learn a little bit more about you. So there's definitely huge I believe there's huge power in those relationships and those and like you said, filling out the gaps when it comes to that. So no, that's phenomenal. No, I think we wrapped up any kind of last words, George, that you'd like to leave the audience with when it comes to, whether it's a passive investor that wants to get in the game, or somebody who's just afraid, with the environment, that any kind of last thoughts you have?
Yeah, I mean, look, I think you should, if you want to invest passively, you need to vet the deal sponsors, and if you feel comfortable with them, if they have the track record, I think it's better to put your money to work for you than just sitting on the sidelines. And you may get 5% interest rate right now or whatever it is, but that's it. You're going to be capped right there, right? And inflation is still, no matter what the reports say, there's still a good amount of inflation happening. Yeah. Versus if you do go in with a good team and deal sponsor, depends what anywhere from 15 to 20% average annually on a deal.
Absolutely. No. And we tell people that all the time, investors, people that listen to our show, make sure you have a solid team. And, obviously we're a little bit biased, with what you have with the construction company, in-house property management, everything that you have, but it's so important when it comes to acquiring an asset and repositioning the asset. The team behind the infrastructure was huge. So we definitely believe it. And, kind of just you want to wrap it up?
Yeah, no, absolutely. George, thank you so much for sharing your invaluable insights and journey with us today. I know our audience have gotten tremendous value. Now, George, we will put your information on the show notes, but for our audience, what's the best way to connect with you, to learn more about you and Elevate? What's the best way to contact you?
Yeah, I mean, I think we have a ton of information on our website. If you go to Elevate CIG, so stands for Commercial Investment Group, elevatecig.com, you can see a ton of free content that we put out there. And if you fill out the form there, if you want to contact us, or if you want to shoot me an email, it's George or Jorge, Jorge, at elevatecig.com. Tell me you heard me on this podcast, and I can send you over a link with like a bunch of free content.
No, that's awesome. That even more value you're dropping for the audience. So no, thank you so much, George. Again, thank you for being on our podcast, and thank you to our listeners for being part of another insightful episode of Passive Investing in US Multifamily Show. Remember to subscribe and stay tuned for more enriched stories and insight into the world of multifamily real estate. Until next time.